Mortgage rates are increasing, housing prices are at an all-time high, and it's causing a lot of affordability issues for many borrowers who are out there. But there's some light at the end of the tunnel. Enter the interest rate buy-down. Now, these programs have been around for decades. They're nothing new. And in fact, when I was looking at purchasing my first property, I was introduced to a 3-2-1 buy-down through Wells Fargo. But how exactly do these programs work? A temporary interest rate buy-down is a mortgage financing option where a borrower pays an upfront fee to essentially reduce the effective interest rate that they would be paying. It makes it a very affordable type of loan option because it lowers the amount that the borrower would pay on their monthly mortgage. The money to pay for the buy-down can come from the borrower's own pocket, or it could be a credit from the seller or the builder if it's a new construction. And my personal recommendation is that you get the seller or the builder to pay for it, and I'm going to explain why, so make sure that you watch this video in its entirety. The main types of buy downs that you're going to see right now are the 3-2-1 and the 2-1 buy down. These are essentially the same aside from the time period involved. So for instance, the 3-2-1 buy down is a 3-year program and the 2-1 buy down is a 2-year program. In the 3-2-1 buy down, the borrower will pay an upfront fee. It's usually a percentage of the loan, and they're going to reduce the interest rate by 3% the first year, 2% the second year, and 1% the third year. After that, the rate will reset to the initial effective rate that they qualified for, and it'll stay that way until the remainder of the loan terms. So for instance, let's say somebody got quoted at 6.75. Well, in the first year, it will reduce by 3%. So essentially they'd be paying 3.75. In the second year, it would be 4.75. And in the third year, it would be 5.75. In year 4, it resets to the initial rate of 6.75, and it stays that way for the life of the loan. The 2-1 buy down, similar, except in this case, that 6.75% is going to turn into 4.75% for the first year, 5.75% for the second year, and in year 3 it'll go back up to 6.75% and stay that way until the loan is paid off. Now, I'm a practical person. I like to look at numbers, so let's put this in practical terms. Let's suppose that you're going to purchase a $600,000 house. I'm going to assume 5% down, and I'll make some other assumptions based on homeowners insurance, property taxes, and even mortgage insurance. Now, these are going to vary based on your area, but typically this is what I would see in my area. So you're going to have to run these numbers for yourself, but this just gives you a way to take a look at what I'm talking about. So let's dig deep. Your monthly mortgage payments are going to be $5,172, somewhere around there. But let's assume you're doing a 2-1 buy down. So in year 1, your interest rate is going to be at 4.75, which means your monthly mortgage payments will be somewhere around $4,535. In year 2, your interest rate is going to shoot to 5.75, which means your payments are going to be about $5,892. So let's look to see just how much this is going to cost, or what you're going to want to ask the seller for a credit for. So we take the $5,172 that you would be paying in year 1 and subtract $4,535. This is the first buy down rate. So the difference in that price is $637. Okay, we need to annualize that. So we'll multiply it by 12 and we get $7,644. Now we're gonna do the same thing for year 2, so I'll speed up the math, but that's annually $3,360. We add those two together, and so we come up with just a little over $11,000. That's how much credit is going to be needed in order to do the 2-1 buy down for this specific scenario. Now, remember when I told you that my advice would be to have the seller or the builder credit it or pay for it? That's because if you pay for it out of pocket, that $11,000 is essentially what you'd be saving each and every month. So $637 a month for year 1 and $280 per month in year 2. So you're really not saving any money if you come out of pocket and do this. What you're doing is deferring that payment at some other time, but you're paying it up front. So you're essentially not doing anything to help your situation in terms of saving money. That's why you want the seller or the builder to pay for it. While buy downs are typically provided on 30-year fixed rate mortgages, there are some circumstances where you can do a buy down on an adjustable rate mortgage or an ARM. I did a video about adjustable rate mortgages, and you should watch that one next. Speaking of next, what I'd really like you to do next is to hit the like and subscribe buttons. especially if you like the content. That just lets YouTube push this out to other people similar like you who would enjoy this content. So thank you in advance for hitting those buttons. Now, one thing to consider is that these are benefits to the borrower, but they are not used to qualify the borrower in terms of the mortgage, right? So for instance, the lender is not going to look and say, oh, you qualify at 4.75% when you do that buy down, right? Because it's just temporary. So they're not looking at what you qualify for or your credit worthiness based on the buy down amount. They're only looking at it based on what you would qualify for without the buy down period. So they are not using this as a qualification tool. You just need to know that up front. The lower monthly mortgage payments over the buy down period offer some temporary relief to borrowers by allowing them to save up some money over the next couple of years. Hopefully, what normally we would want to have happen is that by that time, interest rates we hope would be lower, hopefully lower than the effective rate that the borrower qualifies at that time, and essentially they'd be able to refinance out. Now, keep this in mind. When you go to refinance, you still have to qualify for that new loan, right? It's not that they're just kind of keeping the same loan. You're essentially paying one loan off to go into another loan when you refinance to capture that lower interest rate. So you still have to qualify for that. So if your credit has taken a little bit of a hit or you've changed jobs, especially if you're working in a new industry, you may not qualify to get refinanced to be able to capture that lower interest rate should that happen. But if the rates go up, you're locked in at a lower interest rate. So it's kind of a win-win situation. Just keep in mind that refinancing is not a given. So you're going to have to make sure that you maintain tight credit standards so that when you do go to refi, you are essentially a good candidate. Also with refinancing, there's closing costs. Now you can roll these over into your new loan or you can pay them out of pocket. If you've been saving that money that you were essentially saving from lower monthly mortgage payments, you could essentially apply that to your new closing costs. But you're gonna have to do the math, talk with your tax advisor or your financial advisor and find out which one is best for you. Additionally, you can also pay discount points versus doing a buy down. Now, discount points operate in the same way as you pay an upfront fee to lower your interest rate. And it's usually one discount point for a 1% interest rate reduction. So in our example, if it's a $600,000 home, you can essentially reduce your rate from 6.75 to 5.75 by paying $6,000. Now with discount points, you're locking that rate in for the life of the loan. So it's not a 1 or 2 year period. It's you're paying these points and they're going to give you that interest rate for the remainder of your loan. So in this case, if you were to buy your rate down by 2 points, 2 discount points, it would cost you $12,000. Well, with the 2-1 buy down, to buy down that rate for the first 2 years and then it shoots back up to 6.75, it costs you about $11,000. So in this instance, paying discount points might be more beneficial than doing the buy down. One thing to note here is that it's not always a 1-to-1 ratio, meaning it's not always 1 discount point equals 1%. So I'll give you an example. When my wife and I purchased our home, we paid 0.095% discount points to reduce our rate by 0.5%. And man, I'm kind of kicking myself because we could have probably paid it down much more had I really been paying attention at the time. Now, sellers are highly considering crediting people for buy downs rather than lowering the purchase price. And there's a twofold reason for that. Number one is even if they reduce the purchase price, it still can make the home unaffordable for a lot of potential buyers, which leads to number two. The credit for a buy down makes the home more affordable to many potential buyers. So that is why they prefer that as opposed to reducing the purchase price. So before you ask for a reduction in price, consider asking the seller if they'll credit you for a buy down. Now, which one you get, totally up to you, and it depends on the lender that you go to. But there are other programs that are out there which you can capitalize on for no money down, no closing costs, no mortgage insurance. And if you can combine that or those with buy downs, then you've really figured out a way to game the system.